Every trader has faced this problem. You enter a trade thinking the trend will continue, but suddenly the market flips, leaving you on the wrong side. Or you hesitate to enter because you're not sure if the trend has really changed. This confusion between continuation and reversal is one of the biggest reasons traders lose money. That's where two powerful concepts come in: break of structure and change of character. If you can read these correctly, you'll know when the trend is likely to reverse and when it's safe to follow the continuation. In this video we are going to talk about break of structure and change of character, the psychology behind it, the criteria and rules to find a valid break of structure and change of character, and how to build a complete trading plan to manage trade step by step for consistent results. If you are interested in learning advanced trading concepts, strategies, entry techniques, and how to control your trading psychology to stay disciplined in your trading journey, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A break of structure happens when price continues following its established trend. For example, in an uptrend, the market forms a sequence of higher highs and higher lows. When price pushes above the previous swing high, that break is called a break of structure. It's the market's way of confirming strength and showing that buyers are still in control. The opposite happens in a downtrend. When price breaks below a previous swing low, that too is a break of structure, confirming sellers are maintaining pressure. On the other hand, a change of character is very different. It signals the very first clue that the market may no longer want to continue in the same direction. Imagine price has been trending upward, creating higher highs and higher lows. If instead of making another higher high, price breaks below the most recent higher low, this sudden shift is called a change of character. It's the first sign of a potential trend reversal, telling us that momentum may be changing hands from buyers to sellers. In a downtrend, the opposite is true. A change of character occurs when price fails to create a lower low and instead breaks above a previous swing high. So, in simple terms, break of structure confirms continuation, while change of character signals potential reversal. These two tools give traders a clear framework to read market structure and separate healthy pullbacks from genuine changes in trend direction. To truly understand change of character and break of structure, you need to think beyond candles and lines, and focus on the people and institutions behind the moves. Every candle represents decisions: traders buying, selling, taking profits, or cutting losses. Let's start with the break of structure. When price breaks a previous swing high in an uptrend, it signals that buyers are still in control. Think about what this means. Traders who were short are now trapped, forced to exit their positions, while breakout traders jump in and add more buying pressure. This combination fuels continuation in the same direction. Break of structure reflects confidence. It tells us that the current trend has strength and the market agrees with it. Now, let's look at the change of character. This is where things shift. Imagine price is making higher highs and higher lows, and traders expect the trend to continue. But suddenly, instead of respecting the structure, the market breaks below the most recent higher low. This catches traders off guard. Buyers who were confident just a moment ago are now stuck in losing trades, and many will exit quickly. At the same time, smart money and institutions see this weakness and begin positioning for a reversal. Change of character reflects uncertainty turning into opportunity. It shows us the moment where momentum shifts from one side of the market to the other. The psychology is simple but powerful. Break of structure is confirmation of strength, while change of character is the first clue of weakness or reversal. Understanding these two dynamics gives you a window into trader behavior: who is trapped, who is in control, and where the next big move is likely to come from. To spot a valid setup, you can't just rely on any break of a level. You need clear criteria that separate weak moves from high-probability trade opportunities. For a bullish break of structure, always look for price to break cleanly above a previous swing high within an uptrend. This confirms that buyers remain in control and that the trend is continuing higher. The key detail here is the candle close. A wick alone doesn't make a break of structure. In fact, wicks often signal liquidity grabs or stop hunts. What truly confirms the break of structure is when the candle closes beyond the broken high or low. That strong close tells you that momentum is backing the move, not just a temporary spike. For the validity of change of character, the reversal must originate from a higher timeframe supply or demand zone. Without higher timeframe confluence, a change of character can easily be a fake out. Next, look for a liquidity sweep. This happens when price takes out equal highs or equal lows, grabbing stop losses before reversing. For example, in a bullish change of character, the price may first break a previous lower low or equal lows to clear liquidity, but then fail to continue lower and instead break above the prior swing high. That sequence confirms that control has shifted from sellers to buyer. Finally, the break must be clean and decisive. A change of character isn't valid if price hesitates around the level or only wicks through it. You want to see a solid candle close that proves momentum has shifted in the new direction. A valid break of structure or change of character is not simply about spotting a swing high being taken out or a swing low being broken. It goes much deeper than that. What truly makes these signals powerful is when they occur within the right context, supported by higher timeframe zones, clear liquidity sweeps, and proper structural alignment. When all these elements come together, you're no longer looking at just another random price move. Instead, you're recognizing a setup that carries both logic and probability in your favor. These are the types of setups that allow you to trade with confidence, knowing that your decisions are backed by structure and not by guesswork. Once you've identified and confirmed a high probability setup, the next step is executing your trading plan with precision. This is where many traders rush and make mistakes, but execution is just as important as the analysis itself. Imagine the market is in a clear uptrend and you've already confirmed a break of structure. Now, instead of jumping into the trade the moment you see the break of structure, you wait. Because the market often pulls back to retest the demand zone left behind. This retest acts as confirmation that the level is valid and that institutional orders are being respected. By waiting for this, you filter out false breakouts and protect yourself from emotional entries. Once price retests the demand zone, it's time to zoom into the lower timeframe for refinement. On the lower timeframe, you'll often notice the structure still looks bearish, maybe showing its own small break of structure in the opposite direction. This is normal. Lower timeframes can move against the higher timeframe temporarily. What you need to do is wait for the lower timeframe to align with the higher timeframe demand zone. That alignment happens when you spot a bullish confirmation, either a change of character or a bullish break of structure. This signals that momentum has shifted back in favor of the higher timeframe trend. At this point, you're in confluence with both the higher timeframe demand and the lower timeframe structure. This is your trigger. You enter your buy position on the retest of the new demand zone formed in the lower timeframe. Place your stop loss beyond the previous low of that lower timeframe structure. This way, even if the market creates a small fake move, your trade remains safe. For take profit, think in layers. Start by targeting the nearest swing high or liquidity level to secure partial profits. This locks in gains while reducing your risk. Then, let the remaining position run toward the higher timeframe key levels, where the bigger move is likely to complete. This layered approach protects your account while also giving you the chance to capture the larger swing. In the same way, when a change of character is confirmed on the higher timeframe, the focus shifts to looking for a sell opportunity. Instead of entering immediately, you patiently wait for price to pull back into the supply zone that formed during the shift. This pullback is where the market often rebalances, giving you a chance to align with institutional order flow rather than chasing price. Once the pullback reaches that higher timeframe supply zone, the next step is to zoom into the lower timeframe for refinement. Here, you're looking for alignment between the higher timeframe and the lower timeframe structure. That alignment comes in the form of either a bearish break of structure or a bearish change of character. When this happens, it tells you that the lower timeframe is now moving in the same direction as the higher timeframe supply, which gives you added confidence in the trade setup. Your entry trigger comes on the retest of a minor supply zone that forms within the lower timeframe. This provides a precise and high probability entry point. To protect your capital, always place your stop loss beyond the last swing high on the lower timeframe. This ensures you're safeguarded against false spikes or liquidity grabs. For your take-profit strategy, think in layers again. First, target the nearest demand zone or liquidity pool to secure partial profits and reduce your risk exposure. Then, allow the remaining position to run toward the larger targets on the higher timeframe. This layered approach not only locks in gains early but also positions you to capture the bigger moves that align with the overall market structure. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.